Hey guys, sorry the camera cut out again. Before we took our little break, we were talking about what will determine stock returns in coming years. And even from our stock game, you've probably noticed that announcements, news can affect stock prices. So announcements, news, they contain both expected and surprise components. The surprise component affects the stock prices, as you probably expect. The efficient markets result from investors trading on unexpected news. The easier it is to trade on surprises, the more efficient markets should be, and efficient markets involve random price changes because we cannot predict surprises. So the assumption here is that markets are semi-strong form efficient. In other words, public info is incorporated. Next slide we're going to discuss is on returns. And here you can see that total return is said to be equal to expected return plus unexpected return. So the unexpected return can be divided down into a systematic portion and an unsystematic portion. They have variables for each. They use an M for the systematic portion and a sigma or a small e for unsystematic portion. So in other words, the total return is equal to the expected return plus a systematic portion plus an unsystematic portion of unexpected returns. So let's first discuss systematic risk. Systematic risk is really going to encompass macro level changes, factors that affect a large number of assets. You can think of this as non-diversifiable risk. That's the type of thing that you really should highlight here, is that systematic risk isn't really diversifiable. It's market risk. Changes in the overall economy. You can't depend, regardless of how great your organization is doing or company's doing, if we enter into a depression or a recession, your company is going to be hit by that. So that's important to account for. Inflation, interest rates, they can all affect systematic risk. Unsystematic risk is diversifiable risk. So risk factors that affect a limited number of assets. Risk that can be eliminated by combining assets into portfolios. So unsystematic risk you can actually eliminate. It's a unique risk, and it's asset-specific risk. For example, labor strikes, part shortages, etc. They're very firm-specific. And therefore, if you diversify your portfolio enough, you may be able to eliminate the unsystematic risk. So the principle of diversification is as follows. Diversification can substantially reduce risk without an equivalent reduction in expected returns. It reduces the variability of returns caused by the offset of worse than expected returns from one asset by better than expected returns from another. The minimum level of risk that can be diversified away is the systematic portion. We've seen recently that this can be relatively big, the systematic portion, especially given with the economic downturn. So here we have a quick summary of standard deviations of an annual portfolio returns. You can take a look at this on your own. It's pretty straightforward. You have the number of stocks in a portfolio on the left-hand side. You have the average standard deviation of annual portfolio returns as column 2. And then 3, you have the ratio of portfolio standard deviation to a standard deviation of a single stock. The conclusions here for portfolios are pretty straightforward, and that chart kind of comes along with the same message. As more stocks are added, each new stock has a smaller risk reducing impact on the portfolio. The standard deviation falls very slowly after about 40 stocks are included in a portfolio. So the lower limit for the standard deviation of a portfolio is about 20%. So forming a well-diversified portfolio can eliminate about half the risk of owning a single stock. So uniqueness or risk is kind of canceled out in a sense with reducing the impact of the portfolio. So the key here is that after about 40 stocks are included, that standard deviation is really falling so moderately that diversification won't help too much. But up until then, the diversification is helping severely. So in our game, we've probably noticed that no matter how much we're diversifying, it may not be helping so much in our particular stock game, but that's because we're playing, an odd game in a sense. But in regular retirement, saving for retirement, of course you want to diversify, and the reason that you want to diversify is you can take away a large amount of potential risk. We're still exposed to the risk of macro changes. Systematic risk is what the text is calling that. But you're left. You can actually account for single stock. You can diversify away risks that are kind of characteristics of a particular one stock by potentially obtaining a stock that would hedge against that risk. So, but sticking with that topic of adding certain stocks and diversification, this chart is a good chart, and it kind of highlights what we were just talking about the 40th stock and how the diversifiable risk is almost shrinking to a minimum. But early on, adding one stock really substantially lowers the average annual standard deviation substantially. And that continues to, about 10 stocks, and then past 20 it starts to get a little lower, and then after 40 it's almost negligible. The one thing that I want to highlight here, this next chart is on total risk equals standalone risk. I want to highlight that systematic risk cannot be eliminated by diversification, since it's really representing the variability due to influences that affect all securities in some way. So systematic risk and non-diversifiable risk are kind of the same. So you can think of total risk as systematic risk plus unsystematic risk, or non-diversifiable risk plus diversifiable risk. If diversifiable risk can and should be eliminated, then the total risk for a diversified portfolio should contain only market or systematic risk. So for well-diversified portfolios, you're going to see unsystematic risk is very small. And total risk for a diversified portfolio is essentially equivalent to the systematic risk. The systematic risk principle is there's a reward for bearing risk. There's no reward for bearing risk unnecessarily, however, and the expected return, the market required return, on an asset depends only on the asset's systematic or market risk. Getting into market risk for individual securities is when we're going to start to come into the concept of beta. The contribution of a security to the overall riskiness of a portfolio is involved here. It's relevant for stocks held in a well-diversified portfolio, and it's typically measured by a concept that we've already discussed in class, but we haven't gotten too in-depth in, and that's the beta coefficient. For stock I, beta could be seen as this formula here, which is going to measure the stock's volatility relative to the market. So the beta coefficient is measuring how much risk an asset has relative to the asset of an average risk. So here's our formula for the beta coefficient. Here you have beta I is equal to the correlation coefficient of this asset's returns with the market multiplied by the standard deviation of the asset's returns divided by the standard deviation of the market's returns, which could also be seen as the covariance of the asset's returns in the market over the variance of the market's returns. The beta coefficient can even be described in a different way, and I think we're going to get into that next week. But the important thing for you to take away for right now is what the beta really means. So if a beta is equal to 1, the stock has average risk. And you guys should kind of remember this from your first project, where we did actually talk about the beta. And I basically spoke to you about the fact that beta can be utilized as a measurement of stock risk. So if beta is equal to 1, the stock has average risk. In a sense, basically the stock is as risky as the market in that case. If beta is greater than 1, the stock is riskier than average, and if beta is less than 1, the stock is less risky than average. Most stocks have a beta in between the range of about 0.5 to 1.5. The beta of the market, as I mentioned before, is 1, and the beta of a T-bill is 0. And why do you think the beta of a T-bill is 0? Well, that's because they consider it to be risk-free. All right, so we're going to stop at this point. Next week, one of the things that I'm going to write down that I have to go through is calculating beta. I'll show you in fact, maybe I'll provide you with a quick rundown on how to do that via a video that I can find on YouTube. Then we'll also get into the CAPM and security market line next week. I'd like you guys to read about CAPM, which is the capital asset pricing model, and the security market line. That'll be interesting to discuss next week as an introduction as we move forward into chapters 12 and 13. CAPM does have some problems. We'll also talk about that next week. So I hope these videos helped, and stay safe, and we'll see you next week. Thanks.